I'm going to be talking to you today about high probability trades with weekly option spreads, not calls and puts, but bear calls and bull puts, which I believe are the very best way to generate income on a regular basis. Okay, my goals today are one, I want to give you an honest look at why most traders lose and how to flip the script. You've got market manipulation, and a lot of people just have poor entry and exit techniques. I think the big one is exit techniques. I'm going to be talking to you later on about some of the results of this strategy I'm going to be talking to you about today. And it has a very high percentage of winners. When we do have a loser, it doesn't wipe you all out. Like a lot of people that teach credit spreads, that's what happens. You've got 10 winners and a loser comes along and wipes you all out. We employ what I believe is an excellent exit technique, which we know before we put the trade on. And that saves us and minimizes our losses. So we have an excellent high percentage of winners. And when we do have losers, they are minimal. You're going to learn a high probability short-term income generating trading technique. This is weekly options. I'm usually in and out of a trade. This is not day trading. I'm usually in and out of a trade in probably no more than 3 to 5 days. I'll put these trades on with 10 days till expiration. I never take it all the way through to expiration because the last week gets pretty hairy and pretty risky. If I've made 90% of what I can make, I'm out. I'm out as soon as I can. Okay. I'm also going to teach you how to apply these techniques while leveraging with weekly options, specifically the SPX. And as I go through the presentation, you'll see why the SPX is my chosen trading medium. Once again, my name is Dale Brethauer. I've been a trader for 35 plus years. This is how I make my money, how I've made my money. I'm a hedge fund manager. I've been a keynote speaker with a number of different members. I've written 3 financial books. I am the founder and head trader for optionsinfinity.com. There are 2 things that we offer at the moment. The first is the weekly option SPX weekly option regression, and that's what I'm going to be talking to you about today. The other one is Options Pro. It utilizes the same techniques, only we're looking at options that expire a month from now. So we've got a little bit, it's a little bit slower. It's for people that can't be there and execute trades that sometimes the weekly options demand you to do. Like I said, I've been a trader for a long time. This is how I made my money. At this point in my life, I get a big kick out of teaching people how to become a success. And I listened to the previous speaker, and I thought, man, this guy is right on. I'm going to show you later on when we go to my website that I have a webinar, a canned webinar on there it's called The Psychology of Trading. And some of the things he was talking about were pinpoint to what a professional trader needs to do. I behoove everybody to go there and listen to this. It's a free webinar. It's going to reinforce what you heard from the previous speaker, and it really has turned my trading around, like Renee told you when I attended a seminar by Dr. Van Tharp, and that's what he was teaching me. That turned my trading around. Okay, let's just take a quick look at a trade example using the SPX weekly. And this was a trade that was made back in March of this year. And you can see that what I've got on here is, first of all, I look at candles. I think candles are the way to look at things. They tell you not only who won the session, but by how much. And then these weird little lines on here that's the regression channel. The regression channel, I've been using this for probably 30 of my 35 years. I used to calculate this by hand back in the day before computers. I bought one of the first Apple SEs and started, making these calculations. Nowadays, Thinkorswim can put these on your charts tick by tick if you want to. It's just amazing, the technology and how it saves a trader time and allows them to really focus on what it is that they want to do. But basically, the regression channel, it tells you when the stock is overbought up in this region and oversold down in this region. Now, the SPX is particularly important because the SPX is traded very heavily by a lot of the hedge fund managers, and I know a lot of them, and by the big institutions. So when they are utilizing this information, it makes sense that you piggyback along with that. And basically the premise, the hypothesis is when the SPX deviates from the regression line, which by the way is calculated by 50% of the price above and 50% of the price below at any given time. And you can do a regression channel on any, if you trade 5 minutes, you trade 15 minutes, you trade daily, the regression channel will change versus that time, but it gives you the information you're needed. I always go with the 10-day, 30-minute chart for my weekly option trading. Now, the green lines are plus or minus 1 standard deviation, and the gold lines are plus or minus 2 standard deviations. When the SPX diverts up into this region or down into this region, it's almost like this purple line is a big magnet, and it will revert. The price will revert back to fair value. This is fair value, okay? It's an excellent trend line. Like I said, I've been using this tool for many, many years. It's the hallmark of my trading, and I've done extremely well going against what other people are doing because I see when things are overbought and oversold. By the way, I've got the question box open. So at any point in time, if you have a question, go ahead and type that in there, and I'll stop what I'm talking about and answer that, because I don't want you to be lingering with a question in your mind and not be hearing me as I'm proceeding. What we did is right here, when it was overbought, we went ahead and took a bear call. And a bear call, what we were doing is we were selling the 28.40 and buying the 28.45 for protection. And we got a credit of 85 cents. 6 days later, actually it was only 4 trading days later, we exited when the debit was only a nickel. You say, well, Dale, it fell beyond that. Yes, it did. Absolutely did. But at this point, we had made 94% return. So the question was, why bother for another 6% for another 4 days of risk? So when I hit my goal, I am out. What are the settings on the standard deviation channel? On Thinkorswim, what you do is you go in and first of all, you determine what the time is going to be for the trades. Like I said, for the weekly options, I use 10-day, 30-minute. And you just go in and go with the default at ±1 standard deviation and ±2 standard deviations. It's that easy. It's that easy. Now, this is a standard deviation a bell chart, and what it's showing you is that at ±1 standard deviation, 68.2% of all price will be contained within that channel. Well, when you go to ±2 standard deviations, 95% of all prices will be contained within that channel. Now, that's statistics. Occasionally, we will get outliers. When I see an outlier and it starts turning around, I know I am loading up. I am loading up, because you think of this like the casing on a sausage. It's containing the meat inside here. So if it's right up against the outside, and as a matter of fact, you might have a little pinhole and something squirts through here, it's going to revert back to the mean. And that's the statistics behind how this regression channel works. Let me just talk a little bit about Dr. Van Tharp. You know, he has written a book, and I would say to everybody, please go ahead on to Amazon. It's relatively inexpensive at this point in time. Trade your way to financial freedom. A couple key points I wanted to bring up here. Financial freedom is really a new way to think about money. Most people think they win the money game by having the most money and most toys. Financial freedom means that your money's working for you. It can effectively replace your need for a 9-to-5 job. And it can. It's going to take time. And that goes back to the previous speaker. This is something that when you learn a technique, and that technique has a positive expectation, your job then becomes to do that religiously. You will have losses, you will have losing streaks, but if you have a rock solid strategy and you stay with the rules and you just execute the trades, it's going to bring you the kind of returns you're looking for. It's not going to happen overnight. Paper trading is good. Actual trading in low quantities. If you can't make money paper trading or with low quantities, why do you think when you put bigger money in there, you will? No, take the time. This is not going anywhere. This is not going anywhere. This has been around for years and years and years. That doesn't mean you're going to spend hundreds or even thousands of hours building the foundation for your financial freedom. There was a book written called Outliers. And in that book, he's talking about professionals in any field. And don't you want to become a professional in this field? This is not an easy arena you're in here. The stock market is not an easy arena, and options are an order of magnitude tougher than just buying and selling stock. Okay? But you're going to have to spend thousands of hours. You know, a professional golfer, then when they swing and hit that ball, it looks so effortless, so effortless. You go to a concert and listen to an organist or a violinist, and you go, wow, that is so cool. Well, they didn't start out that way. They have spent thousands of hours building up their profession. Financial freedom is possible once you laid the right foundation. All right, I just wanted to bring that up because, I give a lot of credit to Dr. Van Tharp, and I just wanted to share that with you, and it kind of fits in with what the previous speaker was talking about. All right, are weeklies the best path? Well, this is something you're going to have to look at. Let's take a look at these. Futures. Futures, you can get quick profits because of the large leverage. But 99% of all retail accounts not only lose money, but they lose their whole account trading futures and Forex. Futures and Forex. quick profits because of the large leverage. I did dabble around in the futures market earlier in my life. I was doing quite well for 2 years, and I knew that not many people did quite well, so I thought I really had the key. And I went away from my diversification, and in one day I lost my whole account. I lost my whole account and was close to losing my home. That kind of taught me a lesson. The leverage is a killer. I haven't touched futures since then. If you are risk adverse and you think you can enter in there, you can make a lot of money. You can lose a lot of money too. All right, stocks are good for extremely large accounts where you're fine compounding wealth at a small percent each year. A lot of people do that. I do that. I do that as part of my portfolio. I've got a large portfolio in stock. And I've been averaging, I average, believe it or not, about 20% a year on that. That's unheard of. That's unheard of. But a lot of people, if they're okay with a small percentage per year, that's a good strategy. Selling monthly options, that's good for all size accounts, targeting about 20% per year. Weekly options are good for both small and large accounts looking to make sizable, consistent income. Weekly options, especially weekly stock options, are rigged with explosive gamma and high premiums. This is by design. Okay, if you look at an at-the-money option, it will have two components. One is the intrinsic, and that is the actual dollar amount, which is if it's at the money, it's about zero. And the other is extrinsic, or time value. That time value rapidly erodes. Market makers pocket this money by taking it right out of your account during times of rapid price movement, especially if it goes against you. Let's learn how to join the market makers by selling options on indices. That's what bull puts and bear calls are all about. Because we're never going to sell naked. We always want to have that protection. You can look at an option and say, well, if I sold this naked, I would make a boatload more than if I had an option. However, the margin that a broker is going to charge you is going to whittle down your return to just about what a credit spread would be. So selling naked is extremely risky. By selling options, the hyper fast time decay of premium works in your favor. And that's what we want. This is what we want. This chart shows the days until expiration, and this shows the rapid decay of time value as you approach expiration. This is why most options lose. This time value erodes so fast. What we're going to do is we are going to be the market makers. We are going to be the house in the casino. We are going to sell that to people and watch it erode away. We're going to be the casino. Traders are lured into buying cheap weekly options, exactly what the market makers who sell them want you to do. You're about to learn a strategy that not only allows you to sell weekly options with protection, but do it in times when probability is in your favor. Now, why the SPX? It's the best of the best. Over 1/3 of all SPX volume is now in weeklies, creating a fantastic opportunity. Over 1/3 of all SPX volume is now in weeklies, creating a fantastic opportunity. Why? Because the liquidity is key to spreads. You get a tight bid-ask spread, and you're going to get that with high volume. Large funds and institutions use the SPX to hedge their portfolios. Again, this points towards liquidity. The XPS is priced in for a 1% move, but the SPX doesn't move 1% very often. It creates an 85% win ratio for one standard deviation instead of the standard 65. Well, 65% for one standard deviation is incredible. 85% is because of this, because of the 1% move priced in there, is exceptional. Then you go to 2 standard deviations like the chart I just showed you, and you've got a rock solid strategy. TJ, a good question. His question is the SPY less liquid? The SPY is simply the 1/10 the size of the SPX. They're both the S&P 500. The SPX is 10 times bigger. The reason I like the SPX is I get 10 times the credit versus the SPY. So when I buy a contract of the SPX, I can get the same thing with the SPY. It's just as liquid, but I've got to buy 10 contracts, and now my commissions go up. That's why I focus on the SPX versus the XPY. Good question. Okay, here's another one where I took a bull put, and I think you're starting to see the theme here. We're down here around the -2. We're in. Now, there are a couple other rules that I'm not going to share with you today, but I like to keep things simple. But the big thing is the regression channel. That's what I want to talk to you about today. There are other rules that I use to get in, but here's the crux of it. It's down to the -2, calls for a bull put. How do I determine where to put the bull put? I look at the implied volatility and the expected move over the time period, 10 days to expiration, and I price that in and go to this strike price. Here I get an 80 cents credit. Now, if this were the SPY, it would be an 8-cent credit. All right, see what I'm saying? And you might get some slippage on that. And by the time you pay commission, that 8 cents evaporates quickly, whereas it doesn't with an 80 cents credit. All right. Here I got out with a 15 cents debit. Well, you say, well, Dale, this was so strong, why not let it go? That's 81% return on my investment with 7 days till expiration. It just makes sense to me to get out of that. Okay, that's good, Terry. That's really good. So by what you're saying, today is looking like a bull put play off the 30-minute. That's pretty good. That's pretty good. Here we go. Here's my thinkorswim, and you can see how the SPX came down here in staircase fashion. It didn't just drop like a rock. Came down in staircase fashion. Came down to the 161 on the Fibonacci. Came down to the -2. The -2. This I can't tell you what to do. I can't make a recommendation, but I'll tell you that this is setting up for a bull put. That's very good, Terry. Very good. I'm going to come back to this in just a second. Okay, another question. You use a 5-point spread. Why do you use a 5-point spread? That gives me plenty of credit. A 5-point spread gives me plenty of credit. I really don't want to go to a 10-point spread with only a 10 days till expiration. Just a 10-point spread is twice the credit, but also twice the risk. And I am not risk adverse. I can get enough credit on 5-point spread, so that's what I go with. Okay, Wall Street jargon makes strategy appears complicated, but it's not. It's not. The good news is you don't have to know anything about options to do these strategies. I can walk you through everything you need to know. You don't have to watch the market all day. This is a perfect trading strategy for newer traders or small accounts that are looking to grow them quickly. Now, let me put a caveat on that. Don't jump in there and overtrade your account, because Dale said this is great for small accounts. Paper trade it first. Prove it to yourself. Like I said, don't be in a hurry. Why are you in a hurry? You have plenty of time. Take your time. Learn the strategy. It's great for small accounts. It's not limited to small accounts. I've got a big account and I do this strategy. Not with my whole portfolio. Not with my whole portfolio, but with a portion of it. The strategies are safe. It's no naked selling, no random assignment of stock, and I will teach you how to exit the trade to minimize the losses when you've got a loser. And we will have losers. We will have losers, even though our last 31 trades, 28 have been profitable. 9, that's greater than 90%. Now, I went public with this last July 13th, and since that time, we've had 78% winners. And like I said, we've got an exit strategy to cut the losses short. So this is a this is the best of the best. You're not going to find anything any better than this. Another question here, do you use at the money options? No, I went over that earlier. I always go out of the money, and based on the implied volatility, I will go out of the money. Yeah, if you go at the money, you're going to get more credit. If this thing swings around and goes against us, I can get out. Well, we had one the other day that swung against us, and I got out. With a loss? No, we made 20%. We only made 20%, and I exited, okay? But with at the money, that would not give you a chance to, if you're wrong, to get out and cut that loss short. So I always go out of the money. Try to keep it simple. Try to keep it simple. There's more to it than this, but this is the crux. Step one is you place a directional spread when the SPX is overbought and oversold. And step two is you exit profitable trade on Fibonacci extensions or exit losers on an opposite measured move. And all that I can explain to you. This chart, I just thought I'd bring this chart up. This is a look-see for 1 year, and you can look and see some of our trades. Bull put, profitable. Bull put, profitable. Bull put, profitable. Profitable, 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 profitable. Shaky for a while. I was really considering exiting that, but it came down and it got support here at the -1 of the long term, and I held, worked out good. Profitable, profitable, profitable. There's a loser. There's a loser. I just was not real sure I wanted to stay around with that one. This was an iron condor that was getting away from me. That was a loser. Not too many losers, huh? Here's the 15-month equity curve for SPX war. Of course, past performances are no guarantee of future results. We all knew that. But look at that equity curve. Yeah, we have drawdown. We have drawdown, but my goodness, that is the kind of equity curve you want to, that's the kind of strategy you want to learn. This is something, like I said, is going to be around for a long time. Now, how much do you, what's the trade size? Well, use this little formula. And I never risk more than 2% of my option portfolio per trade. So assume you had a $5,000 portfolio. 2% of that is $100. The average loss on a trade is about 50%, a little bit less than that. So that allows you to invest $200 for that size account. The average contract cost is about 80 cents. You can buy about 3 contracts. You can use this formula for any size portfolio. If you got 10 grand, all of a sudden you got 6 contracts. You got 20 grand, you got 12 contracts. You got 1 grand, you can maybe do 1 contract. You're going to be higher than this, but you're trying to, build your portfolio. And remember, just go slow. But like I said, we started this publicly July 13th of, that should be 17. That's 17, that was last year. Or was it 16? Yeah, it was 16, yeah. 3 contracts per trade, which by the way is nothing, return $7,000 on a $5,000 portfolio. Once again, past performances are no guarantee. Okay. I just want to bring up some of these because, I've been talking about paper trading and going slow and everything. And I kind of zeroed in on a couple things, couple testimonials, if you will, that people wrote in and they're talking about that. And I thought that'd be good to share. Jim F said, I paper money traded and did well. Last week, I sold my first real money trade, a bull put. And according to my buy hand calculations, I made 59%. That's the way to start. Mike H says, I've been making money on the SPX. I started with 1 contract. Now I'm up to 10. That's the way to do it. Sankar said, when following your rules, I'm 5 for 5, averaging 74% per trade profit. And Pete W said, I'm really enjoying trading the SPX. I started out paper trading in January. That's great. Started trading live in March, 2 months of practice. The results have been fantastic. I've done 8 trades with 4 to 10 contracts, gaining about 55 cents per contract with 100% winners. Well, it's not always going to be like that. He says, can't get any better than that. No, it can't. but in the long run, we've had 78% winners. And like I said, we've got a strategy to cut our losses. Okay. So how do you begin learning about this? Okay, the first, and I'm going to go to the website and I'm going to show this to you. Maybe I'll go over to Thinkorswim first. You can see some of the. I always go with 2 screens. I've got the 10-day, 30-minute chart, but then I've got the 90-day, 1-hour chart. I kind of hone in on this one. This one tells me whether I ought to do a bear call or a bull put. If I'm below the regression line on the longer term chart, I'll be looking for a bull put opportunity. And if I'm above, I'll be looking for a bear call opportunity. And you can see right now, we're right about on the regression line. So either one is fair game. So I look at that and I say, well, it's fair game. I can go with a bull put or a bear call, either one. Now I come over to the shorter term and I say, okay, this is where I make my trades. Okay, and I look at this and I say, well, I can take a bull put. This looks like a bull put. The market's been pretty weak, but I'm going to go ahead with a bull put. I'm going to go ahead with a bull put. And it's going to be down around here somewhere, okay? And what's going to happen is if it goes up, it's going to be fantastic, because the further and further it goes up, the more and more theta is going to work for us rather than against us. See, time is our buddy, not our enemy. It's your enemy when you're trading straight calls and puts. Screen cuts off on the right side. Well, Aaron, I wish I knew that earlier on, but maybe it's just this one. Maybe it's just this one. Okay. So what I want you to do is we're going to go to my website in just a second. I want you to begin learning as a free member, and I've got a lot of free content there. That one of them was trading psychology, feeding off of the previous speaker. These are all free to you. I want you to become a free member. Then if you want to go the next step on this SPX war, you can buy the master course. The master course. And how much is the master course? $19.95. I think it's $19.97. To you guys today, we're making it $19.97. It goes along. It sells retail for about $500. I want you to hear me. I want you to be one of my mentees. I have done this for a long time. I know how to do it. I will show you how to do it. All you have to do is go to optionsinfinity.com and get this. First of all, become a free member. Then go ahead, if you like it, go ahead and get the masterclass for $19.97. Here's what you're going to learn. Why this strategy is so powerful, actual real-time trades, how I set up my charts for regression channel, measure moves, Fibonacci ratios, and why. What are vertical spreads? The trading rules, how to find a trade, how to enter a trade, and how to exit profitably or with a loss, step by step, with examples. How to determine a realistic expectation from this, and the proper trade size for any given portfolio. That's what you're going to learn in the masterclass. Okay. So let's take a look at the website. Here it is. Pretty simple. It's the first thing you're going to do when you come to the home page is you're going to click on this button to become a free member. Now, I'm gonna come back to this area right here, but here's what you can get as a free member. If you don't know a lot about options, here's options 101. Leverage, the leverage of options, charts, my trade size. Here's the psychology. The regression channel, a little bit more about that. Fibonacci's, macro MACD, money flow index. And then you can learn about, every good business has got a trading plan. This is 3 modules on figuring out your own trading plan. Once you have a nice portfolio, you want to hedge that. What do you do around earnings? And I'll tell you quickly what you do around earnings is you get out. Okay, then you've got other things. You've got access to pre-recorded webinars that were done for my members that you can actually see, how those go. You can review all the blog articles and okay. So let me go back up. Oh, let me just go here for a second on the blog. You say, well, what's that? I've got about 20-minute, and there's a 16-minute. I talk about Japanese candlesticks. That's free. Talk about trading economic news. That's free. Proper trade size. Financially strong stocks for our portfolio this year. That's free. Trading peak performance. 8 winning concepts of super traders. Think and Grow Rich. This is a rehash of Napoleon Hill's book. Trading the Iron Condor, Credit Spreads Demystified. Which is better, to be a buyer or seller of options? Okay, those are all for free. Those are all for free. Now, you look at all that free stuff and you go, man, you know, this guy, I like this guy. I like this guy. He's a straight shooter, and I've learned a lot already. Boy, oh boy, I bet you for another $19, he's just going to blow my mind. And that's what you do. You go right in here and you sign up for the SPX War Master Class, and you log in and purchase it for 19 bucks. If you like that, you might want to do these other two. You know, it's totally up to you. And ultimately, at the end, if you like all that, you say, well, you know, I want to become a member. Okay, that's cool. That's cool. You become a member. What do you get as a member? Let's see if I can get it. Yeah. As a member, it doesn't break it down for me. Bummer. Okay. Oh yeah, it does. Yeah, it does. Yeah, it does. We got some statistics here. You're going to get the course. You're going to get trading session reviews Tuesday, Thursday, and Sunday. Real-time text and email alerts. Monthly live meetups, third Tuesday of the month. Okay, so there's a lot there for you if you really are serious about taking your trading to the next level. And I want to, like I said, I don't want you to jump into this thing. I want you to become a free member, listen to some of the stuff I have to say, buy the master course, which is relatively cheap. And if you want to go further and you want me to be your mentor, I would love to do it.